You're listening to Outcome by Design with Paul Weinstein, a series about the untold stories of the tech world. Let's get into today's episode.
Our guest today is the legendary Jeff Epstein. Jeff is an operating partner at Bessemer Ventures. In addition to his work in venture capital, Jeff also currently sits on the board of directors of such varied Silicon Valley success stories as Twilio, Okta, and Kaiser Permanente, just to name a few. He is also the former CFO of Oracle, obviously one of the world's largest software companies. And if that isn't enough, Jeff also teaches at both Stanford Business School as well as the engineering department.
That's right.
Jeff, welcome to the show.
Paul, thank you very much. It's great to see you.
Yeah. So as you know, what we do here at Outcome by Design is to try to get a better perspective on the how and why of things, and then extract some sort of that wisdom to share with our listeners. And it's not necessarily the press release version, but all the kind of crazy real life twists and turns that happen along the way. For me, that's the interesting part of the whole story. The story is not necessarily just in the numbers, but it's in all the personalities, the people, and the path that gets followed for success or for failure. So now, given all that, I thought you would be a great person to have illuminate some of this for us. You've had obviously an amazing career. You've been a tech executive, a board member, investor, teacher, and in the center of this craziest ecosystem for a long time now. So given that, let's jump into it. Obviously, Silicon Valley and the Silicon Valley model is growth trumps all else. Grow, raise money, grow, raise some more money, raise some more money. And, eventually you'll have an IPO and everybody will be happy. That's the pinnacle of success story. That's the fantasy. Now, obviously, I have kind of a bias in all this, but the actual fact is that 98% of successful startups, and these are the successful ones, meaning they return some or more money to their investors than themselves, get acquired, don't have an IPO. And so we're in the middle of a pullback for the tech sector now. Funding is getting tighter, potential recession looms, and in general, the climate is looking a whole lot different than it did 12 months ago. So here's the question to you. Do you think CEOs should start thinking about their own exit options? I've got various different opinions on that. Some believe it's a binary thing. You either focus 100% of your attention on managing your business, or you focus 100% of your attention on selling, and you can't do both well. While others think that CEO's main job is mainly to focus on an outcome to begin with. It's all about optimizing this outcome for investors and employees. And they should always be evaluating their options. So I'm curious, given your experience, where do you stand on all that?
I think the CEO should spend 95% of his time building the business and 5% of his time on the relationships with the companies that may acquire the company. And the reason is the way large companies work is they don't meet a company that they've never heard of before and say, we want to buy you in the next 3 weeks. It's just not the way it works. The companies have what we typically call a roadmap or a market map. When I was at Oracle, we would have a market map for software for financial services companies and software for telecom companies and things like that. And we'd literally have a big sheet of paper, and we'd have white boxes for the categories of products that we didn't have, and we'd have red boxes because it's the Oracle red for the categories of products we did have. And so let's say we had a mortgage software product, but we didn't have a credit card software product. And our goal ultimately is to sell every software product that JP Morgan wants to buy, and that Bank of America and every other big bank wants to buy. And so if we're missing a product over time, we want to fill in that chart and have it be all red. And historically, over the last 20 years, Oracle has filled in that chart roughly half by internal product development, half through acquisitions. So if we have a box on that chart and we know that you're one of those companies, we want to meet you. If we don't know who you are and you're not on that chart, you have to sort of persuade us that you could get on that chart. And that persuasion takes time. You have to talk not to the M&A team. You have to talk to the software team and the product team. And we have to talk to customers and figure out, do our customers want these two different companies to be owned by the same company? Does it benefit the customers in some way to have it be part of a suite or part of it be part of a group of products? And so if at some point you are for sale and we already have a relationship and we know how you might fit into our product line, we at Oracle are going to be very interested in buying you at the right price. If we don't know much about your company and we've never met you before, that process will probably take months or years. And it might not fit in with your schedule. So going back to your question, how much time should you spend on it? The answer is it would be useful for the CEO to say, who are the 3, 5, 7 companies that might acquire us? Let's try to figure out a way to have a relationship with them. Maybe there are ways we can add value to each other short of an acquisition by co-selling our products or by licensing our products. And then if 2 years, 5 years down the line we're for sale, we have an audience where we have relationships.
Yeah. Well, that makes sense, obviously. I'm curious, for Oracle, and in my experience, and I think in general, Oracle was known for being much more thoughtful and planning about acquisitions than a lot of other big internet companies who were much more, kind of market responsive. So, where do those lists come from? I mean, how do you were the CFO, it ultimately kind of went up to you, but how do you get on the list?
The list at Oracle, it's from the product and engineering team. So there's someone whose job it is to lead all the software products for the financial services sector, all the products for the telecom sector, all the products for healthcare, things like that, or all databases, or all financial products, financial software. And that senior product engineering person says, here's what we have today. Here's what our roadmap is going forward. And we have X hundred or 1,000 software developers who could work on this. They can't do everything. So some of it we'll build and some of it we'll buy. And sometimes if there's a company that's already got a great product, even if we could build it, we're much better off buying it if the price is reasonable, because we'll get customers with it. We'll get great code that we can build on, as opposed to starting from scratch and being many years behind.
How often were these things opportunistic, and how much of them were, planned out 1, 2 more years in advance? Just curious, in your experience.
I would say that virtually all of them were on the market map when we made the acquisition. And half of them were done because the head of product engineering said, this is a product we need. I've looked at these 3 potential acquisition targets. This one I like, this one maybe, this one actually the product's not very good, so I'm not interested. And then they develop relationships. They work with the M&A team on an outbound basis of trying to persuade the company to sell. And the other half is inbound, which is the company's on the market map, but we don't have an active process going on. We get a call from the company or a banker saying we're for sale. And we said, that's great. We met you 3 months ago or 6 months ago. We know a lot about you. We want to engage. The banker calls us and says, here's a company that's for sale. We've never met with them. We don't really know who they are. The probability of us engaging is low.
Yeah. So let's take an example, a specific example. So you're the CEO of a Series B, Series C startup. It's been growth. Raising money has been easy. So that's really been your focus. Your board has been pushing you towards, don't think about anything else, just think about growing. Now there's a pullback. Your cost structure is kind of set up for, a goal that is kind of no longer achievable. You can't just raise the money as easily, or if you can, it comes at a high cost. How do you shift your focus? Because, you're moving from a company that was valued and was just thought about it just in terms of growth. I'm a high flying, startup company. I'm growing so fast. My valuation is increasing exponentially due to that growth. Now I've got to cut back because capital is harder to come by. And I'm worried about that growth story going away. How do I manage that process and manage the kind of expectations associated with that, both for my employees and for my investors?
Well, let me start with the investors. The metrics that investors a year or 2 ago would have invested at a certain valuation based on a certain revenue growth rate and size and profit margin. And those metrics have completely changed. So it's not helpful to say, what was it 2 years ago and what is it today as a percentage of 2 years ago? You should just forget about 2 years ago. 2 years ago could have been 200 years ago. It's just irrelevant. The question is, what are the metrics now? And if you already have investors, that's a very important question for you to ask. So if I were the CEO or the CFO of a company today, I would meet with my investor privately and I would say, here's where we are. We may raise, let's say, in a year. What revenue, profitability, revenue growth rate, CAC payback, net renewal rate do I have to achieve for you to be interested at any valuation a year from now? And if you're interested, what do you think the valuation is going to be, assuming the market a year from now is the same as the market today? And if the investor is a good investor, they will tell you. they'll say, well, you have to cut your burn from $1 million a month to $500,000 a month or some other number. And you have to get your CAC payback down from 3 years to 18 months or something like that. So part of it is a change in the capital markets, but part of it is a worsening in the actual underlying economics of the business. So if you were growing at 100% a year before and you had 10 salespeople, and now you went out, you hired 10 more salespeople and your growth rate is half, your productivity per salesperson just fell by a quarter because they're adding half the revenue for twice as many people. And so if you used to have an 18-month CAC payback, meaning I spend $1 on sales and marketing and I earn that $1 back just to cover my sales and marketing costs, not to cover my R&D or G&A costs. If I earn that back in 18 months, but now I've gotten 4x worse. Now I've gone from 18 months to 6 years. The economics have gotten terrible. So it's not just that the stock market went down. It's that your personal economics at your company got terrible. And basically what you have to do is figure out how to get better. So you probably need fewer salespeople and better, more sales effective strategy. And part of it is doing more with less, and part of it is figuring out a way that if customers are having longer sales cycle and less likely to buy, you should have a different go-to-market approach.
Do you have any examples? I mean, you've been through these booms and busts multiple times. Do you have any examples of companies that have, not only survived, through a downturn and a complete change in their cost structure, but also ones that have managed to thrive and come back and regain all that momentum and growth?
Well, my favorite example of that is Priceline, where I served on the board for 16 years. So Priceline went public during the internet boom in 1998. Within a year, had a $30 billion valuation with gross revenues in the single billions of dollars, losing billions of dollars. And they had name your own price airline travel, and then they had name your own price mortgages, name your own price gasoline, name your own price groceries. They were doing all these different products, and people thought it was going to be the next Walmart. The people who were buying the stock at that valuation thought it was going to be the next Walmart. That they had this unique way of taking low prices and extra inventory and making it available for everything. The market crashed. The stock went down 99%. It went down from 30 billion to 300 billion, losing hundreds of millions of dollars of cash. People thought it was going to go bankrupt, which is why it went down so much. The new management came in, dramatically cut costs, stopped doing everything that was non-travel related, and focused only on name your own price airlines, and had stabilized the business. By the time I got there, the market cap was about $1 billion. Then we added hotels, and we realized that since there are only a handful of airlines in the United States, and they don't like working with travel agents, and they don't pay travel agents much, we were much better off working with hotels. And then we built up our hotel business and put all of our effort on hotels and minimized the effort on airlines. And then we were fortunate enough to be able to buy Active Hotels in the UK and Booking.com in the Netherlands, put them together, and then emphasized international hotels where the economics are even better than the US hotel economics. And now we're the biggest travel agent in the world. We have a $90 billion market cap. So we went from 30 billion to 300 million, down 99%, and now up, what would that be? Up 300%, 3,000%, I guess.
Right. Yeah, that's a fantastic story. So what do you think made the difference? Obviously, the management team got changed out, but just in terms of, how the business was managed from the board perspective where you were there, was there some sort of sea change and everyone just thought how they thought about everything?
Well, in our case, we were, to some extent, we didn't have too many choices because we were going to go bankrupt if we didn't make these changes. So if the situation you're in is life-threatening, everyone understands. All the employees who stayed understood what had to happen. And so what we did is we were doing a lot of things, and we said, let's not do that. Let's only do one thing or very few things. And so that decision by the CEO and the board to focus is extremely important. It's also what Steve Jobs did when he came back to Apple for the second time. There's a great, if you just YouTube, Steve Jobs talks, he talks about how they had dozens of products, none of which were, he said, all our products are terrible. So what we're going to do is have, I think it was 4 products. And famously they said, all of Apple's products are going to fit on this table. And so by cutting out all this other stuff, you can focus on the things that are important. And then you don't need all the costs that support all the other stuff. So that naturally cuts your cost. And then you want to be more efficient and do things in a cost-effective way anyway. And then just focus on that one thing or those very few things and try to do them well.
Well, let's bring it back to kind of what, a good example today. So what I see a lot is that you have companies that have raised a significant amount of money, certainly more, they raised more money than at any time in history that a company could be able to raise at the stage they were at. So you've got a Series B company that's raised $100 million and they still have a significant amount of that money in the bank. But, the economics of their business have fundamentally changed overnight. Maybe they were always different and nobody realized it, but, certainly it's something that everybody's waking up to. So you've got a bunch of money in the bank, you're not running out of runway necessarily anytime soon, but you're faced with this choice of, what do you do? Your business was based on being able to raise, literally an infinite amount of money in the future. And so while you may have 2 years of cash or 3 years of cash in the bank, do you continue to just run your business as you did before because you got the money and then just hope that, the markets turn around and that growth is valued again and you catch up to, where you're supposed to be valuation wise? Or, do you do the opposite and take that money and cut everything way back and just assume that, things are not going to get better and you're in it for the long haul? Or, what's the wisdom there?
The framework that I use is, let's take the example of you had an infinite amount of money. So it's not, even your money's not going to run out in 3 years. It'll run out in 100 years. You still wouldn't waste it. You still wouldn't hire salespeople who are only, and pay them $100,000 a year if they're only bringing in $10,000 a year of revenue. So the first thing you do is you say, what are the key metrics that I need to run my business independent of the capital I have? And the two key metrics in my mind are the effectiveness of your sales and marketing, which I use as a CAC payback. And the second is your net renewal rate, which is, do your customers like your product when they buy more of your product or they cancel? And if I'm a B2B SaaS company, the metric that I use is your CAC payback should be a maximum of 2 years. Optimally, it's 18 months. And your net renewal rate should be over 100%, ideally 110 or 120%. So if you're hitting those metrics, then I'm saying, hey, things are pretty good. If you have plenty of capital, maybe you should keep on investing the capital, because if you can grow a company from 10 million in revenue to 100 million in revenue, you're going to be worth a lot more at 100 million in revenue than you are at 20 million if you're sort of growing slowly. But if those metrics aren't working, you're just throwing money away, and you shouldn't do it. Now, then let's say, well, okay, now let's reintroduce the capital constraint. So now you say, okay, I have 100 million of cash. I have 2 years of runway. I'm burning 50 million a year. The question in your mind is, how much risk do you want to take on the capital markets being open when you run out of money 2 years from now? And most of the companies that I'm talking to are saying, there's no need to take that risk. I can run my business so that I can achieve break even before I run out of money. So if you extended the runway from 2 years to 4 years, let's say, and you instead of burning 50 million a year, burn 25 million a year, or maybe 35 million this year, 25 million next year, 15 million the year after that, and then you break even in the fourth year, you actually have a path to, in today's economic environment with today's slower sales cycles and maybe a recession coming up, you have confidence that you can get to break even without raising money. And that's what most of the companies that I'm dealing with are actually doing. They're saying, I have enough cash to get to break even without raising again. Now, there's some companies that only have 6 months or 12 months worth of cash, and they can't get there from here. So they have a different issue.
Don't you find by cutting those costs, extending that runway out, you're kind of almost by definition going to limit your growth? I mean, if you're doing anything right, you've at least paid some attention to that.
Well, that's true. So there's a trade-off. You will be worth less if you do that than if you continue growing faster, burn more, assuming your metrics are good. But you are able to raise money in 2 years at a higher valuation. So you're risking the company, because let's imagine that there's another 9/11 or another stock market crash in 2 years. And the month before you're running out of cash, things look great. And then all of a sudden the markets close and you just can't raise money. At that point, you literally may have to shut the business down or sell for 10 cents on the dollar. So if you often entrepreneurs are risk takers and they're willing to take that risk. As a CFO, I was never willing to recommend that risk. And as an investor, I don't think I'd recommend that risk either. Why? There's no need to risk it, because even if you're growing slower and you're worth a little less in 4 years, once you're breaking even, you can start making money and raise more money and invest it more, and you can continue growing, and maybe you've lost a year or two's worth of growth. It's not a permanent loss; it's a temporary loss.
That's a very rational way.
You're not deciding today to grow slower forever. You're deciding today to grow slower for the next 6 or 12 months, and then you reevaluate.
So given all this, in this whole process, you're still thinking about, okay, is the value of my company something that's ever going to get to the point where, we're going to be the next Apple or we're going to be the next Google? So at some point along in this process, you're going to start thinking about, you may disagree with me on this, but you're going to start thinking about what other possibilities exist for my company. How else can I, make this whole thing pay off for both myself and for my investors? You don't think that at some point in that journey, when you're 3 or 5 years in and things have gone up, things have gone down, you start thinking about, well, I should be a little bit more serious about exploring what are the other possibilities for a good outcome here? Or you still think it's like 100%, you just keep focused on your business. And, if something good is meant to happen in the acquisition category, it'll happen. Good company, the conventional wisdom, right? Companies are bought, not sold.
Yeah.
So when people say that, I think what they mean is that, you put your effort into your business, don't necessarily think about the exit so much, and good things will happen. Do you agree with that? Or do you think that at some point or another, you become more realistic about these things?
There are 3 possible outcomes. One is that the company stays independent and either becomes a very profitable private company like Bloomberg, or goes public and still has continuity of ownership, or it sells to a strategic, or it sells to private equity. And so, as we said before, I think if you think the IPO is less likely, is a low probability today over the next 5 to 10 years, and you think one of the others is more likely, then I think it does make sense to spend a small amount of time, on the order of 10% of your time, building relationships either with the strategics, or if you're more likely to be bought by private equity, with key private equity firms who focus on technology, to build relationships there as well. And just to have that, start the relationship now, so that if you need it 2, 3, 4 years down the road, you have continuity of relationships. I do think that's very, very helpful.
Yeah. I just find that, again, this is my own personal bias, but there's always kind of disconnect in my mind between the great possibility, which everybody wants, me included, of, building something that's worth billions and billions of dollars. And you've seen that, right? Twilio is a good example of a company that is just worth a tremendous amount of money. They did a tremendous job there. Where all along the way, there could have been another outcome, which would have been less optimal for them, I imagine. So, they did a good job kind of picking and choosing where they put their energy. But the fact still remains that 98%, if you do the math on where you should allocate your time, you're going to have to put, and you believe that, acquisitions do take some work. They just don't come out of nowhere. You're going to have to put some time and energy into that process at some point, right? I'm not saying it becomes your sole focus, but the thing that I run into all the time is you run into this dilemma with really kind of the founder or the CEO, and then the expectations that the board have of the company itself. And it's difficult to have an honest conversation, either from the board member to the CEO or the other way around, about putting some effort into these other options. Because, one way or another, if it's the board member or investor talking to the CEO, they're worried about the entrepreneur thinking that the board has now lost faith in them. And if it's the other way around, they're worried about, the CEO is worried about the board member thinking, or the investor thinking, that they're weak and, kind of given up. So, my question for you, as someone who's just a tremendous amount of experience with this, is how do you have those honest conversations that are, in the end, better for everyone to have these things kind of out and not delayed? How do you have them without worrying about kind of the optics of the whole situation? Do you have any wisdom there?
Yes, the world is not black and white. It's shades of gray, and there's very little certainty in business. It's all probabilities. So, you use the number 98%, but for any one company, you might have a different percentage. But if I were the CEO or a board member at a company, it would be very useful to have a conversation at a board meeting or even one-on-one, and to say, let's just think ahead the next 5 or 10 years. What's the probability of an IPO? What's the probability of a sale to a strategic? What's the probability of a sale to private equity? And the answer is highly unlikely to be 100-0-0. It's likely to be, there's a 10% probability of an IPO and 70% to strategic and 20% to private equity, or whatever the number is. And then you say, okay, well, how much effort should we be putting into that now, thinking about it, and when might that happen? And if the answer is we have plenty of cash and there's no urgency on it, maybe it's not a priority now. If we have 18 months of cash and we think we might actually start a process in 6 to 12 months, it's probably pretty high priority. So we just want to keep our options open. It's the rational, sensible, good business thing to do, to understand what your options are, to keep them open. And then there's an added benefit if you're talking to a strategic, which is the reason a strategic will be interested is typically because you have a product and the strategic has distribution. That's the most common thing. If that's the case, is there some way that they can use your product and you can use their distribution without an acquisition? Could they become a minority investor and invest in your next round, the way Bessemer Ventures has invested in dozens of companies? Could they be a sales channel for you, the way one of my companies created a sales relationship with Concur and generated a third of their revenue? So it's very meaningful revenue. Adaptive Insights had a relationship with NetSuite for many years, where NetSuite did financial accounting software, but they didn't have a budgeting module. So they private labeled Adaptive Insights budgeting module. And if you went to NetSuite budgeting, you were in Adaptive Insights. And so that was they were actually integrated into the product. So there are a lot of business benefits to having these relationships in addition to the potential ultimate acquisition.
Yeah, no, obviously I agree with that. I mean, people forget that even Google started out as being a search engine for Yahoo way back in the day. But your view is very rational. My experience has been, it's not that there's so much personality and emotion and confirmation bias that plays into the whole process, that having that conversation of like, well, what's our likely outcome in 6 months, in 12 months, in 18 months? How should we allocate our resources? That almost never happens. Or if it is, I rarely see it.
Well, I think the reason I like probabilities is you can have a disagreement on probabilities, but it's not going to be back to an extreme. So let's say the CEO says, I think there's a 70% probability we're going to go public. And the investor says, I think it's 30%. That's a big difference, but it's not 100 and 0. And then you can have the conversation, okay, well, even if it is 70% probability you're going to go public, that still means it's a 30% probability there's going to be an acquisition. When do we start talking to the potential acquirers? And the CEO might say, never. And the answer is, well, that's the wrong answer. So is it a year from now? Is it 2 years from now? And it probably has something to do with how much cash you have left.
Sure. Have you actually seen that rational conversation takes place? And if so, who brings it up? Does the CEO bring that up, or does the board bring it up? Or
usually the board brings it up. I've tried to think the times when the CEO has brought it up. When I've personally been on a board and the CEO has brought it up, the CEO has already decided to sell. The CEO comes to the board and says, I think it's time to sell. Let's talk about it. I've never been in a situation where the CEO says, I want to talk about it for something that might happen 3 or 4 years in the future, because they're just not focused on it. And I think it's actually the board's adding value by raising the question with the CEO, because if you wait for the CEO to realize that it's imminent, it may be too late.
Yeah, I agree with that. And I've seen that from board members. I've seen it. I think I probably see this more than you. I see it from the CEOs and the founders themselves too. They don't bring it up again to their board because of that fear I was talking about earlier. And so I like the way you described kind of how to frame the discussion. Let's talk about probabilities, because it seems less threatening. It makes the CEO seem more thoughtful and maybe a little less kind of fearful of the future. And so I like that framing of it, to think about, you could bring this discussion up if you're interested, you're CEO, you want to talk about this, with your investors, to bring it up in terms of, here's how we're thinking about these things. We think there's a 40% chance that we'll have an IPO in the next 3 years, and we'll have a, whatever, 50% chance that, we get acquired. And I'm just wondering from, the board's perspective, how you think about that. And, if you have an opinion on how we should allocate our resources. That seems like that's a great idea, much less threatening.
Paul, I'll tell you the one reason why it doesn't happen, why the CEO doesn't bring it up, which is if it's a venture-backed company and they've had several rounds of financing and the CEO doesn't control the votes, the CEO, let's say, owns 20, 25% of the company, or maybe co-founders do, and there are 2 or 3 influential investors, the CEO is legitimately worried that the CEO doesn't want to sell, but 1 or 2 of the investors would want to sell. And if they bring it up, they actually trigger the sales process. And they're hoping by not bringing it up that no one else brings it up and they just get to go another year or 2 without triggering the sales process. So the worst case scenario for the CEO is they try to have this very rational conversation about probabilities. Everyone agrees. They go talk to Salesforce, or not Salesforce these days because they're not acquiring something, but Oracle's still acquisitive. So they go talk to Oracle, and Oracle says, great idea. Here's $500 million. We want to buy you. Some of the investors might say yes when the CEO says, no, I know it's a possibility 5 years down the road, but I don't want to sell now. But the CEO might be forced to sell if they don't control the board. So that's, I think, an important reason why the CEO doesn't typically start the process if they're not a control shareholder, because they don't want to lose control of the process.
Yeah. So, I mean, do you have any way of kind of making that process more rational for everyone all around? I mean, it seems like waiting is not going to be the best scenario. I mean, sometimes obviously it turns out that way, but for the most part, to being fully aware and cognizant of what you're doing and planning requires some sort of, agreement between the board and the CEO, at least in some sort of framework for thinking about how they plan for the future. So how do you get around those kind of structural issues that cause all those fears and triggers if it's not having, a rational conversation about the whole thing? Is there some other way?
Well, what I'm saying is I understand why the CEO seldom brings it up. I think the board should bring it up. I think if the board brings it up and the CEO says, I don't want to talk about it, then it's the board member's responsibility. Each board member has a fiduciary responsibility to maximize value for all common shareholders and not to entrench the CEO, for instance, or any other goal. So as their legal fiduciary responsibility, they say we need to optimize value for the shareholders over time. Talking to the strategics is one way to do that. Ideally, you'd have a rational conversation to reach agreement. If you don't reach agreement, then it's a pretty important strategic problem for the company, when the owners of the company and the CEO, who theoretically is hired by the owners, have a different point of view. I could tell you if it was a private equity owner, the private equity firm would say, we control the company, we're doing it. If it's a venture-backed company with 2 or 3 venture firms who collectively own the company, that's much harder for one venture firm to do because they don't want a reputation that they have sold the company out from under the CEO.
Yeah. And usually at that stage, the founders are so, I mean, not all the time, but are so inextricably linked to the company that, it's a big decision to think about replacing that person. That would be a big deal.
Usually what happens is you have a conversation at the board level. The CEO says, I don't want to do this now. Let's think about it next year. And then you put it on hold. And then if the business is going fine and value and you're hitting your numbers and everything's going great, you just wait. But then next quarter after that, you miss your numbers, the revenue is declining, and then you're saying, hey, the CEO is not performing. It becomes increasingly increasingly likely that we're going to sell the company because we're not performing. Increasingly less likely we're going to go public. The pressure builds then to revisit that. And the CEO at that point, if the CEO has been missing the numbers for a year, they don't fight as hard because they realize that they had a chance to go for the gold and maybe they missed it.
Yeah, no, I think that's true. At some point, we don't have time today, but it would be interesting to have a conversation about the different motivations of all the other, the players, the venture investors that's sitting around the board. They've got all sorts of things going on that are above and beyond, the individual company that they're sitting on that board for, and how that.
Well, that's true. How old your fund is and things like that. But I think the single most important thing is the company performing well. If the company is beating expectations, overwhelmingly the board and investors are going to say, that's great, go, cheer you on, keep on going, keep on doing what you're doing. If the company is missing expectations and frequently missing expectations, every board meeting gets harder, and then the board gets more active and starts to figure out, what, we have to change something. What are we going to change? And sometimes the thing you change is the CEO. Sometimes the thing you change is you decide to sell the company.
Right. Well, good. I mean, this has all been super useful. I got one more question for you. So, you've been again on all sides of these types of transactions, ups and downs. So here's an open-ended question for you. Above and beyond what you've already said about the metrics, what else really matters? Like, what matters in the end of the day?
What matters to whom?
To an entrepreneur, a CEO, like in the sense of, what am I trying to do here? I mean, frequently, I honestly, you would think it's not true, but I get that question. Like, what is my goal here?
Yeah, that question often comes up with when the founder thinks about raising another round of capital and getting dilution. And so one way to think about it, not just in the M&A context, but in just the fundraising context is, do I want to own a higher percentage of a smaller company and not raise capital and try to just grow on my own? Or do I want to raise more capital? I get a lower percentage of the company because I'm selling more equity in the company, but I own a smaller percentage of a bigger company. And different founders have different points of view. I was on the board of Shutterstock, where John Oringer was the founder, never raised venture capital, was profitable immediately. And today the company is worth $3 billion and he still owns over 40% of the company. So he kept a very large ownership position, but it never became Figma, which was in the same category, or Adobe, which perhaps could have been even bigger. If he had taken venture capital earlier on, could he have built even a bigger company? Maybe he could have. And then there are other companies like Box that famously raised lots of capital every year. They're raising more and more money, and the founders of Box have single-digit ownership of the company. So that trade-off is partly a personal one of risk versus reward, partly one of control. There's a lot of things that go into it. It also depends to some extent how old you are. I think if this is your first company and is your goal to maximize the value of this business, or do you think you might, if you end up selling this company, you think you might do it again? And what I've seen very often happen is someone says, you know what, I want to maximize the probability of success, even if I personally don't make as much money. And so if I can raise more money, get great partners, and I have a terrific outcome, and I've made some money, and then I've been CEO for 5+ years of this company that had this phenomenal outcome. Now I can go back and now I can raise money, and I can raise a lot of money at a very high valuation. And my second company is going to be the one where I really make it big. There are a number of examples where that's happened. Yeah.
That requires a tremendous sense of self. And I applaud those people who can actually have that kind of foresight. Well, thank you, Jeff. I don't want to take up any more of your time, but it's been great. I love hearing what you have to say. And I think, your success is probably well-deserved.
Paul, it's always a pleasure. And it's great to work with you in our portfolio. And we admire what you've been doing. And thank you for everything you've done for us and what you're going to continue to do.
All right. I think that's it.
You've been listening to Outcome by Design with Paul Weinstein. Don't miss any of our upcoming stories from the tech world. Subscribe to Outcome by Design wherever you get your podcasts. And if you enjoyed this episode, leave us a quick review. You can also send your comments directly to info@paulvweinstein.com. Until next time.